Steve Liang's got a great product with Real Estate IQ, and he's going to do a little market update, I believe, for us for Florida. So let's jump into it. Steve, take it away.
Thank you, Nate, for the introduction. So really glad to be here, everybody. I want to show, this is what I have. I got 3 slides for you. We're going to look at the Orlando market update. This is as recent as our October data. And then we'll also look at the off-market leads, which a lot of folks are very interested in. And we're seeing a little more properties that are coming on the market off-market. And everybody's interested in off-market motivated sellers. So we're going to look at those statistics in a little bit. Okay, so this is the real estate market in the Orlando market. You can see that the median sales price compared to last year, it has gone up. It's if you look at the months of inventory, we're talking about 0.9 month in the months of inventory, really low supply right now. And the days on market, 25 days compared to last year, which was about 41 days. So things are moving a lot faster, very low inventory still. And so we're kind of sitting tight. There's a lot of short-term volatility, everywhere, that also includes the real estate market. So we're monitoring this all the time. Next slide. There we go. Is our pre-foreclosures. So what we're looking at are the number of pre-foreclosures that are being filed in all the major metro area in Florida. For Orlando, we want to look at the Florida triangle, the light blue line. We're seeing that in general, it's hovering around 200 per month. And then we also take a full sum of all the off-market leads. So pre-foreclosure is really one very valuable type of motivated seller. There's also a whole bunch of other ones. So when we aggregate them, we can see that especially for the Orlando area, if we look at light blue, where it says Florida triangle, it's been trending up. So there are more and more off-market opportunities that are coming to the market. Next, I want to share with you how to learn more about us. So with Real Estate IQ, we are a data company. One of our best-selling product is the motivated sellers. And this is all the rage right now because very low inventory, not a lot of houses on the market. So how can we find deals? We have to find them off market. And those are the key ones where we're looking at for motivated sellers. So all kinds of distressed sellers. You can see we have 12 different types. I'm going to type in my email address on the chat. So if you're interested in seeing a consultation, send me an email and I'll connect you with one of our team members to show you what the product is. So really cool. This is motivated sellers. And then there's also another a product that we have where you can get their phone numbers and email address, all kinds of contact information. So you can do more outreach marketing to these motivated sellers. And another one that we want to test the market on is what we call market insights, where we can find out, for this person that you're trying to reach, some interest information, a little more about that person, so you can be a lot more effective when you market to them. Stuff like, do they have a pet at home, or there's so many additional information. So if you're interested in seeing these insights, we're looking for kind of beta clients. We want to work with you and help you find success in this insight while we're kind of beta testing this new product. Thank you for having me. I'm going to type in my contact information to the chat, and please enjoy the rest of the program. Thanks, Nate, for having me.
Thanks again, Steve. Appreciate all you do for real estate investors out there, both in Texas, Florida, and all over the country. So let's just jump right into it. We are talking about due diligence, and we're talking about not only single family, but today we're talking about multifamily. And I've got somebody that's got a tremendous amount of experience And that's Ben Suttles with Disrupt Equity. But before we get him on the program here, just want to go over some quick items if in case you're very new to this Wednesday workshop from NuView Trust Company, and talk a little bit about what we do and why we provide such a tremendous amount of education for you guys. NuView Trust Company is a self-directed IRA company. We're based out of Florida. We do have clients all over the country. What we offer as a product is a self-directed IRA. Don't get confused with that term self-directed. We just offer retirement accounts for those of you who want to invest their retirement into alternative assets instead of traditional assets. I'll talk a little bit about the difference between an alternative asset and a traditional asset here in a second. But just so you know, we've been in business since 2003. That makes us one of the veterans in the industry. And currently we have about 15,000 active investor clients that are using their IRAs, old 401ks, old 403bs, any employer sponsored plan that you might have had at a job that you're looking to invest now can be invested in all sorts of things. And what we do at NuView Trust Company is we hold alternative assets instead of traditional assets. How much alternative assets do we have under management currently? Close to 2 billion. So it's a large amount of assets that we hold that are alternative assets, but the industry itself is growing. We've seen it just in the past decade or even half a decade increase or almost double the attraction for people who are looking to just diversify their investment portfolio when it comes to their retirement account. And understanding all your investment options is something that NuView Trust Company takes very, very seriously, because we don't sell investments to our clients. We basically allow clients to have more freedom in what they invest in, but they invest by making their own decisions on what they want to hold in their retirement account. And that's why we call it a self-directed IRA. Self-directed is just a marketing term. It's a marketing term that's used very loosely sometimes. So don't get confused with that term. You may go to your guys at Fidelity or Charles Schwab and say, hey, I want to start self-directing my IRA. And they say, well, you can have a self-directed IRA with us. You can self-direct it into all these wonderful mutual funds that we have to offer you. So don't get confused. Self-direct is just a marketing term. The difference between an IRA at a Fidelity and an IRA at NuView, though, is that your Fidelities and Charles Schwabs are going to limit you to what they sell: stocks, bonds, mutual funds, CDs. That does not make them bad guys. It's just the nature of their business because they're licensed securities brokers. NuView Trust Company is not a licensed securities broker. We're still a custodian, but we don't sell anything. We're not licensed to sell anything, nor do we want to sell you anything. We want to put the keys in your hand and let you invest in anything that the IRS allows. And when you look at the IRS code, when it comes to investment options in your IRA, they don't tell us what we're allowed to invest in. They only tell us what we're not allowed to invest in. And the list is extremely short. When it comes to investments that can be held within your IRA or 401k, there's only two things you're not allowed to hold: life insurance contracts and collectibles. That's it. So if you wanted to use your IRA to own a rental property versus a stock, you can do that. You just have to find a company like NuView that's willing to administrate that asset on your IRA's behalf. You have to find the real estate, but we'll hold it so that you get your tax benefits that you get inherently because it's an IRA or a tax-exempt trust. We have a lot of clients that choose to be more passive in their self-direction. They find investment opportunities, but they don't want to deal with the toilets and the tenants and the pissed off people and the brokers. They don't want to deal with the headaches that come with real estate, but they want to make some of the money that comes with real estate. And that's why we have our guest on, which we're going to bring in a second. We're going to talk a little bit about how you can invest passively into real estate, all types of real estate, but most specifically multifamily. But it is an investment option that a lot of our clients choose because they find they can make above average returns. It's still secured in a lot of cases by real estate, but they don't have to do all the work to find the deal, vet the deal, and work on the deal. So what types of IRAs can you self-direct? Well, we have several types of accounts just here at NuView. We actually have 7 types of accounts if you want to look at those. We have personal plans that can be self-directed. That would be your traditional IRAs and your Roth IRAs. Again, these can be self-directed into anything the IRS allows. You can buy rental property, you can buy land, you can be passive, you can be a note investor, you can buy cryptocurrency. The list goes on and on and on. We also have self-employment plans for those of you who are self-employed. You may own your own business or have a small, startup company for yourself or your employees. You can also set up 401ks, QRPs, which are just qualified retirement plans, SEP IRAs, simple IRAs. Those are all accounts we offer here at NuView. But again, you have more investment options when you invest through an account here at NuView. We also have non-IRAs like your health savings accounts and Coverdell education savings accounts, which are not IRAs, but they are tax advantage vehicles that you can put money in. You can invest those vehicles, and then you could take money out and pay no taxes on any of the gains, provided you're using the distributions to pay for health expenses for you, spouse, and family, or education expenses for your kids or your grandkids. So when you look at the 7 types of accounts there, and I know there seems to be 8, QRP and 401k are the same type of account. People just call them different things. But when you look at those plans there, realize those plans are treated better when it comes to taxation than you ever are as an individual. So if you're trying to get to retirement and you have some investments in mind, realize if you're just using your money to invest, your money as a tax-paying individual, the money in your bank account, you have to pay taxes every single year on every dollar you make. So it's hard to grow your bucket of wealth because you're a taxpayer. When you look at a Roth IRA, a traditional IRA, a SEP IRA, basically every account there that I'm showing you, these are accounts that you can buy and sell investments, but pay no capital gains tax on. And in a perfect world, not even do you escape the capital gains tax on your investments if you use the right accounts like a Roth IRA or a Roth 401k or the specialty plans there on the side. When you take distributions, the distributions are also tax-free and penalty-free if you use them right. So if you're really trying to get Uncle Sam out of the equation, if you're really trying to grow a bucket of money free of tax that can exponentially grow in value, make sure that you are using these tax advantage plans here that I'm showing you. Okay. So what can those plans be invested in? Well, again, anything but life insurance, contracts, and collectibles. So what do we see our NuView clients invest in most often? Real estate's one of them. How they find those real estate, how they find that real estate, it could be just on their own. They may have MLS access. They might find off-market deals through Real Estate IQ. They might find deals at foreclosures or buy tax liens, or invest in what we're talking about today, which is multifamily or apartment buildings. They may even invest in commercial property or land. Again, the options for investments are almost limitless. You just have to find a company like NuView that will hold those types of assets in your IRA. And then we have a lot of clients that invest passively through notes, either secured notes or unsecured notes, to investors, to real estate investors or startup companies. And we have a lot of people that invest passively into entities, whether those entities are LLCs or joint ventures or partnerships. A lot of times those LLCs and partnerships may own real estate. It's just that the entity gives a little asset protection for those of the investors involved. But you could have an LLC that has an ice cream shop or runs an actual business. There's nothing preventing you from doing that with your IRA as well. And we do have a growing amount of clients that are diversifying into digital assets as well. So that's going to be a growing thing that we'll talk about. We actually have some guest speakers coming up, down the road in the next couple of weeks. But really, the options are available to you. You get to choose your investments. And that's what the powerful thing about a self-directed IRA is. Not only do you get to pick your own assets, you get the tax savings, and you have more freedom to choose what you want to invest in and what you're comfortable with. So when we talk about investment options, this is when we want to get our guest speakers on the phone here or on the program. Ben, if you want to jump on here, I'm going to give a little introduction to you. The reason why we bring guys like Ben on, the guys like Real Estate IQ, all the people that we bring on is because at NuView Trust Company, we can't sell investments. And I get this question every single day. Nate, what should I invest in? Can you show me some investments? Unfortunately, I can't show you what to invest in, even though I invest. Because I am the director of a self-directed IRA company, I'm not allowed to show you investments or pitch investments to you. And nor do we allow our guests to pitch exact investments. But guys like Ben with Disrupt Equity have tremendous amount of experience investing and using other people's IRAs to fund some of their multifamily projects that we want to bring them on and talk a little bit about from an education standpoint, what you should look for before you invest passively into deals that either Disrupt Equity has or anybody might have. And just some of the things you should look for. And I can't wait for this presentation because it tackles a lot of the questions a lot of our viewers have, which is, can you show me the paperwork? What paperwork is involved? How's the process work from beginning to end? And Ben took a lot of time to put some slides together that not only go over what to look for, but here's the forms that you can expect. And here's some of the things in different markets you want to expect. So Ben, without further ado, I want to bring you on. I want to thank you for spending some time with us today. I'm sure the viewers are going to get a lot out of what you have to present, and I'll just let you take it away.
No, I appreciate it, guys. NuView, you guys are doing a great job. I actually learned a few things on your intro there. I didn't realize that you can invest in cryptocurrency through your self-directed, and I also didn't know that the health savings accounts, which I have,
Yeah.
you can direct in this way as well. So, we're learning things every day. This is an educational business, right? And so, but wanted to thank you first and foremost, Ben Suttles. As mentioned, I'm a co-owner of Disrupt Equity. We are a commercial real estate firm, private equity company based in Houston, Texas. We own multifamily throughout Texas and in Georgia. We're also looking to get into Florida as well. So we currently own about 2,500 units. We manage over 3,500 units because we also have a property management company as well. And, today I'm going to kind of look at it from the passive investor side. Right. I want everybody to understand that what we do is we're on the active side. We're actively going out and we're seeking out investment opportunities. We're getting them under contract. We're structuring the deal. And then ultimately we're managing them on the back end for a profit.
And if you don't mind, before you get too far, Ben, I just want to mention to anybody, if you have questions during the presentation, go ahead and type them into the chat box. We'll get them into at the end, and make sure everybody stays all the way to the end, because not only are we going to answer questions, but I got a little giveaway for people on a very special announcement. So stick with me because I'm going to give some free stuff away after Ben is done. So sorry to interrupt there, Ben. I'll let you take it away. You've got all control now.
No, not a problem. Not a problem. So, I like to make that distinction. And I also wanted to caveat my presentation that I'm also a passive investor in deals as well. So, I look at it from both lenses, both the active investor side, as well as I look for opportunities on my own too, right? There might be other people that are doing creative deals that I want to get into. So these are some of the things that me and my business partner, Ferris Musa, kind of came up with. And we've given this presentation a couple different times because I think it's important for people to understand what they're getting themselves into, because I'm a big proponent of an educated investor is a good investor. So what I'm going to go ahead and do is I'm going to share my screen here. So bear with me here while I fumble through the technology piece of taking over the screen. Hopefully everybody can see that, and we'll kind of dive right into this, right? So, ultimately you can't learn everything about multifamily in a 30-minute presentation, but I'm going to try to give you the highlights, right? So we're going to talk about some of the red flags that a passive investor should be on the lookout for, as well as, just the process in general. And then ultimately, how do you kind of not necessarily underwrite a deal, but what are some things that you should be on the lookout for, or go do your own due diligence on, not only the sponsor, the active investor that's putting the deal together, but just the deal itself and maybe the submarket. So we'll get right into this. As mentioned, Disrupt Equity is the company that I co-own with a gentleman named Ferris Musa. We have about 250 million in assets under management throughout Georgia and Texas, trying to get in the Florida market. It's pretty competitive. Apparently everybody's moving there. But we're hopeful that in 2022 we can break into that market. We also own several other companies as well. Disrupt Management, our property management company, being one of them. And then we have some other ventures as well. So I always kind of tell people I'm an entrepreneur first, and then I'm an investor second, right? Because at the end of the day, what is multifamily? For people that don't know, it's apartment complexes. And an apartment complex, for anybody that's ever lived there, and most of us have at some point in our lives, it's a business, right? You've got employees, you've got vendors, you've got clients, which are your tenants. You've got revenues coming in, you've got payroll, you've got insurance, you've got all these things, right? And what I've done throughout my career is I've owned and managed businesses. And this is no different than that, right? So I'm going to kind of get right through there, hop into this. So we're helping investors achieve strong passive income by leveraging multifamily syndications. That's kind of our motto. That's, and I'm sticking to it, to kind of throw out a cliche there. But, bottom line, as mentioned, we have bought and sold over $250 million in real estate. We've also exited 7 large apartment complex deals over the last probably 2 or 3 years. So not even this year, which everybody's probably familiar with. It's the market is on fire. We had some successful exits pre-COVID as well. And each of those has on average 30 to 100% average annualized returns, right? So what does that mean? Right? An average annualized return, and I'm not going to get too far in the weeds because I don't have enough time to, but you're going to essentially have a total return, right? That's the cash flow that you've made from the investment plus the proceeds of the sale combines to become total return. Then you divide that by the amount of years that you're in the investment, and that's going to get you your average annualized return, right? To give you guys some perspective, up until probably 12 months ago, the stock market was on average probably 6 to 8 over the last 100 years on an average annualized return, whereas these are a lot more outweighted, right? But as mentioned, we've got over 3,000 units, Texas and in Georgia, right? Disclaimer, I'm not going to read this, but my lawyer always makes us, we put this on every presentation, right? Obviously, this is just for informational purposes only. We do, ask that you review everything with your legal, tax, professional advisors before you make any investment, including with us, right? And we always tell people, read what you're signing, folks. It's important. And I'll kind of get into that here in a minute. So meeting agenda, so moving right along here. Why multifamily real estate? The multifamily offering docs, due diligence as a passive investor, some red flags. And I'll go through a quick case study. This is one of the deals that we've sold. And then ultimately, I think the most valuable part of these presentations is the Q&A. So be thinking of some questions, right? And just, you can chat them you can put them in the chat box. You don't have to shout them out, right? But, some things not only about multifamily, but just real estate in general, maybe be an entrepreneur. I'm open to answer any of those questions. So why passively invest in multifamily, right? Very little time commitment. And we'll get into the paperwork here in a minute. But you essentially got to fill out 4 pieces of paperwork. You got to make a wire transfer. That's it. That's all you got to do. We don't expect our investors to do anything else other than that. Right now, we do hope that they do due diligence on us. They do due diligence on the property and the investment, and that they ultimately read the monthly updates that we provide to them. But I can guarantee you, because I obviously have the data behind it from who opens up our emails, that a lot of people just don't even do that on the back end, right? But that's on them, right? At the end of the day, but very little time commitment. That's probably one of the most, I guess, advantageous things for investing in multifamily. Cash flow, right? Why do we get into real estate? Cash flow is king, right? As the old saying says. Substantial tax benefits. We have people that always come around about Q3 asking, what do you have closing by the end of the year? I need depreciation. I need to offset gains that I've had in this market or this stock or crypto or whatever it is. I need to roll some money into a real estate deal because I need depreciation, right? Cost segregation is our friend, folks. And I'm not a CPA. I'm not a cost segregation company, but I do encourage you to obviously look that up. I think everybody's probably somewhat familiar with the 1031, which is just another strategy of deferring taxes. Cost segregation is in the form of depreciation. If anybody knows kind of somewhat the tax law, right, you could depreciate assets over a certain amount of time. This essentially just allows you to push some of that up. Instead of doing, I think, 27.5 years, you can do some stuff in year 1, some stuff in year 5. So it's just essentially pushing up that depreciation so you can get it in those first 1 to 5 years. And sometimes it's substantial. So look into that. Once again, everybody's tax situation is different. Strong appreciation. Everybody knows the market is on fire. Cap rates have probably decreased by 200 or 300 basis points in the last few years. Now, I'm not saying they're going to continue. Obviously, they can't go to 0. Maybe they certainly can't go to negative. But at the end of the day, right, I think that there's going to be continued wins at our sales because debt is ultimately cheap. There's a lot of equity in the market, and ultimately everybody needs a place to live. So strong appreciation, I believe, for the next 10 to 20 years is going to continue. Access to a strong, stable asset class. Like I mentioned, you kind of look at the hierarchy of needs: food, water, air, shelter. right? It's not one of those things, and this is not to ding on any other asset class, but there's certain asset classes that people can probably think of, I won't name any names, that maybe aren't necessarily needed, right? Or as COVID taught us, maybe aren't needed as much. So, and ability, this is what we're talking about with the NuView team, right? Ability to utilize your self-directed IRA to invest into these projects as well. So what's included in the multifamily docs? Now, that we alluded to this a little bit earlier, right? You're investing in an LLC that then owns the real estate, right? So it's what's called a single purpose entity, right? And what I'm doing is I am selling you shares of that LLC, right? Now there's a certain way that I have to do it through the SEC. It's either going to be a 506B or 506C, and I'm not going to get into that today, right? But certainly look those terms up. And in order to do that, there has to be certain paperwork that has to be filled out and provided to us. The overall document that you're looking at is a PPM. Now, the PPM outlines everything from the offering to the risks associated with the offering. And I think actually out of the 97 pages of the PPM, I think 96 of them are the risks, right? Because at the end of the day, right, 30 to 100% average annualized returns is pretty nice, but there's ultimately a fair amount of risk that goes along with these two. So I got to obviously put that out there. But the PPM goes through all that. You have a company and operating agreement that ultimately governs the whole entire entity and how things are done, right? The structure of the deal, what voting rights the passive investors might have or might not have, right? So it's important to understand that. The subscription agreement is really, this is the document that outlines the sale of those shares between yourself and the LLC. So if you wanted to buy 100 shares, typically they're valued at $1,000 per share, right? So you're going to say, okay, I want to buy 100 shares, it's 100,000, and then there's an actual document that's showing the sale of that, and that is the subscription agreement, right? And then typically there's either one of two things, depending on the offering that we're providing: an investor questionnaire or a third-party accreditation that you're going to have to go through. Now I'm probably gonna spend 2 minutes on this because this is pretty important for people that are new into passive investing in multifamily. The investor questionnaire is essentially, you're just filling out a questionnaire. We have, questions that kind of go through, what's your business acumen? What's your experience with investing? What is your net worth? What is your liquidity, right? How long have you invested in real estate? There's a certain level of due diligence that we have to do to, either prove one of two things: that you are sophisticated, i.e. you know what you're investing in, right? And that you have some level of experience in investing in it, or B, you're accredited, right? Now on a 506B offering, I can have up to 35 sophisticated investors and then an unlimited amount of accredited investors. Now you're gonna say, what's accredited? Look that up on the internet. I don't have a whole lot of time to explain it, but it's typically, most, I guess, simplistic way to think of it is $1 million net worth, not including your primary residence, or I think it's 250 or 300, excuse me, I don't have the exact number on me, but look it up on the SEC's website, is how much you've made the last 2 years and expect to make that this year. And it might be 300 with your spouse. So that's on a 506B offering. On a 506C offering, right, you have to go through what's pretty much described as a third-party accreditation site. So it's no longer going to be you filling out a questionnaire. It's essentially, you're going to go on this website and they're going to verify that you are accredited. You have that $1 million net worth. And don't think of it as this onerous thing. It's actually not too bad. The other way that you can also, check that box is by having your CPA or your lawyer attest to the fact that you're accredited as well, and we'll accept that. Now, typically, whenever we put out an offering, right up front, we're going to say this is a 506B offering or this is a 506C offering. It's not going to be both. It's going to be one or the other. And depending on that, will dictate, can I invest in this or not, depending on if you're accredited or not, right? So that is the other piece of paperwork. So those are the 4 documents that you have to fill out, and really not a lot. You'll probably take longer just reviewing the documents than it would be to actually fill them out and sign them, right? And, add in the wire transfer, which is going to take you 5 or 10 minutes. It's ultimately all in, you're probably spending an hour or 2 of your time reviewing the documents and actually fulfilling the wire transfer. So due diligence as a passive investor, right? So this is not an all-encompassing list. There's probably plenty of other things that I'd love to add to this, but I only got a 30-minute slot here. So how's the deal structured, right? What is the split between the active investor, myself and our team, and the passive investors? Typically we'll do anything from an 80-20 to a 70-30 split, right? With the lion's share going to the passive investors, right? Sometimes there's a preferred return, which we'll get into in a later slide. Sometimes not, right? So you need to understand how it's structured. What's the expected hold time, right? And if you're used to single family and maybe you offer money to, house flippers or something like that, and you're used to only having your money tied up 6 to 12 months, this is probably not the right investment for you. Typically the hold times on the multifamily properties are 3 to 7 years, sometimes less, especially in the market that we're in, but sometimes it could be more, right? And typically that's going to be, in fact, it should be dictated in the paperwork, so you know exactly what you're getting yourself into. And be prepared, folks, to write it out. If they say it's a 7-year hold, it could be a 7-year hold, and you need to be comfortable having your money wrapped up that long. What fees are being charged, right? Some stuff is customary, some stuff's a little bit on outside of being customary, and you just need to understand what that is and how are those calculated and what's the actual dollar amount of those fees. All of this should be disclosed within the PPM, which includes the investor doc. What is the business plan? Are they doing any CapEx? Are they increasing rents? Are they demoing this building or constructing another one? Any myriad of things could be a part of that, and you need to be comfortable with that. We have investors that don't like to do heavy value add plays. They don't like boarded up properties or properties that are vacant. They want to just step into something that's nice and clean and almost turnkey. And you need to understand what that business plan is, and is it in line with the box that you want to stay in as far as your investment goals. What is the reversion cap rate, right? This has a high impact on returns. So at the end of the day, when you say, well, what's a cap rate? Okay, so a cap rate's if you did nothing else to the property, you didn't improve it whatsoever, and you bought the property all cash. Let's just use a simplistic way, right? Cap rates on multifamily right now are anywhere from 4 to 6, right? And so let's say I bought that multifamily for 100 grand, right? The expected return would be that 4 to 6% of the 100 grand, right? And so it's just a way, because multifamily and commercial properties in general are so unique and different from each other. It's a way to kind of tie them together and determine, is this a good deal or not? And don't equate a low cap rate to a bad deal either. It's just one metric of many metrics that you should just be checking the box off of. Okay, does this feel reasonable, right? And then ultimately, how's the debt structured? What kind of loan are they getting on the property, right? Is it a bridge loan? Is it a hard money loan? Are they paying all cash? Or are they getting some kind of a Fannie Freddie loan, right? Which is typically a little bit more long-term, right? So you need to understand that, because that will have a high impact on returns, right? What is a return of my capital versus a return on my capital, right? People are like, what the heck? It's just the one word that's off on this, right? Return of capitals, I'm literally giving you your money back, right? It's not and then a return on your capital is, hey, you have your money invested in this deal and I'm giving you a return on it. So there's a big difference between the two, and it will impact your tax, liability, or, along with returns. And so you need to understand that and ultimately ask questions, right? What are the investors' voting rights, and who are the primary decision makers on the deal, right? Typically, the managers will be listed right there on the PPM and the operating agreement, right? You need to understand, if somebody's presenting you the deal, but then there's these other people that are involved that are the managers and have 100% say so on how the investment is going to roll out. What are these people? What are you doing in the transaction, right? You need to understand, you need to ask those questions, and ultimately it's your money. If you don't feel comfortable with it, I'd say you might want to walk on that one. But if you get a chance, right, you say, hey, I want to talk to XYZ manager, because they're really the ones that are going to be running the ship here, right? So understanding that and that dynamic is important. Is your sponsor investing in the deal? Skin in the game, folks, right? Remember, I'm an LP. I want to see that first and foremost. And we do that in every single one of our deals. Typically 5 to 10% of the overall equity that we raise is coming from disrupt equity. So that's important. Not maybe as important to certain people, but for us it is. And so I wanted to put that out in front of people. Rent and population growth. What's the crime score? What's the school rating in the submarket, right? You need to understand this stuff and do and we'll get into this in a later slide, do a basic due diligence on the area, right? But I'd say the most important thing as a passive investor when you're doing due diligence is you're backing the jockey, not the horse. You need to understand who's putting the deal together, because I always say a good operator can turn a bad deal good, right? And a bad operator can turn a good deal bad. You really need to understand what I'm trying to say there. They can muck it up real quick if they don't know what they're doing, right? So you need to first start there. Then I always talk about look at the submarket, right? Where is it located at? Real estate is location, 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 and then the deal. That's the hierarchy that I look for. And I've got 7 figures invested in multifamily on my own. So take my advice if you would on that, because I think it's one of the most important things being in this business for the last 7 years. And once we talk about analyzing the submarket, right? So there's a little plug there, city-data.com. Some of it's a little stale, right? You have to really pay for more updated information, but we always wanted to provide a free tool that you can always get some perspective on, right? Is the city growing, right? Is there a growing economy? Is the economy diversified, right? The submarket, what's the average income of that area, right? Is there employment, proximity to different industries, right? Government, is it landlord friendly? Is it tax friendly? Right? And then pricing and cap rates. That's important to at least understand, right? If you say, okay, I'm invested in Florida. Florida is a 4.5 cap market, right? Well, that same asset in Texas might be a 5.5 cap, right? Everything now seems priced sub 5s, but you kind of get the point. It's going to be different markets, and you need to understand how that dictates into pricing, right? Because you could have a 1970s, deal that has 200 units, maybe same construction metrics, and that's in Florida, and that's worth 250 a door in Florida. That same deal might be worth 150 a door in Texas. Doesn't mean that the Texas deal is any better than the Florida one or vice versa, right? You get a perspective here that each market's going to have different pricing and different cap rates, and that's going to ultimately dictate different returns in those markets too. But I'd say the most important thing to walk away from here is you want to invest in places that are diversified, that have a growing economy and a growing population. We look at the Sun Belt. Doesn't mean that there's not opportunities on the West Coast and up the Eastern Seaboard or elsewhere, but that's typically where we look at, because all of these boxes are checked in the Sun Belt. But check it out, city-data.com. Got a lot of great information. Google is ultimately a great resource in general, so you should check that out as well. There's just a lot of good resources. I love that the internet has just allowed people to do more due diligence on this stuff. So multifamily deal structures and returns, right? So here's some common ones. Once again, folks, you can skin this cat 1,000 different ways. This is more typical of what you're going to see from us, right? But I've seen it done a lot of different ways than this. And ultimately, what are you comfortable with, right? What are your investment goals, and does this match what you're looking for, right? You've got a straight split, right? Whereas the passive investors take 70%, the sponsors take 30, right? There could be a preferred return, right, of anywhere from 6 to 10%, right? Now you ask, what is a preferred return? A preferred return is how's it stated, right? You're going to get preference over the split, right? So let's say we raise $1 million from our investors, hopefully a lot of them from the NuView folks, and of that $1 million, let's say we give a 10% preferred return. The first $100,000 coming out of that investment is going back to our investors. Then, if there's any additional money on top of that, then we do the split, right? Whereas the straight split, that 100 grand is being automatically split 70-30. So there's a preference there. And typically the way that you're going to see a preferred return done, the lower the preferred return, the lower the risk. The higher the preferred return, the higher the risk, right? That's typically how it's done, not all the time, but I'm just giving you some perspective. And then there's more creative ways of doing it, which is a waterfall, right? Say you've got an 8% preferred return, you get a 70 split up until an 18% IRR. So you're going to get, as a passive investor, 18% IRR. Let's say we kill it and it's a 30% IRR. All right, you're going to still get your 18%, but after that, we're now splitting it 50-50, right? And there's, like I said, a myriad of different ways beyond that. So typical returns that you might see from a multifamily deal. average annualized return of 15 to 20%. As I showed in an earlier slide, ultimately it can be way higher than that. But we want to obviously temper expectations, and none of this is guaranteed, right? Internal rate of return, that IRR metric, and no, I'm not going to go through the calculations of that. That's what spreadsheets are there for, but you can certainly check it out. Anywhere from 10 to 17% plus, right? Cash on cash, 7 to 12, right? Total return, right? When I explained this earlier, cash flow plus net proceeds, typically in our deals, 100% plus in years 3 to 7. So you're looking at that 2x equity multiple. So red flags. This is probably one of the more important slides on this whole thing, right? Property specific warning signs, decreasing population. We talked about that. We don't like that. Low absorption rates. That means that, people are building properties, but nobody's moving into them. That's a bad sign. Decreasing rental growth, right? Your rents are going down or they're plateaued. Comps are not near the subject property, right? Somebody's gonna, say, oh, well, we're gonna increase rents $500, in the first year, and there's no comps in that area. Because even though this is commercial, we still use comps that are doing more than, I'm throwing out a number, 250. So in my mind, that person, what does that person know? Probably not much. And they're just being aggressive, right? And underwriting is critical to analyze the submarket, right? So these metrics are more telling to that specific submarket or a neighborhood versus, say, a large MSA, right? A lot of the brokers like to say, oh, we've seen, 10% rent growth in the Houston MSA. Houston MSA is pretty big. So, what if you're just investing in Katy, which is a submarket of that? In Katy, it's like 15 to 20%, right? So it's better. But in some cases, if you're investing in, say, the Port of Houston or Pasadena, it might be 5%. So ultimately look at that submarket and understand what's going on there. Business plan / return warning signs. They don't disclose the distribution splits, right? I think that's a big red flag. I don't even know if that's even legal. But bottom line, people can create their own paperwork, and you just buyer beware. You need to understand that. No GP fees disclosure, right? They don't tell you how much they're taking fees for, right? That's important. There should never be a guarantee of anything, right? At the end of the day, we can't guarantee anything. Even the preferred return's not guaranteed. So anybody that's trying to go out there and say this is guaranteed is blowing smoke. They don't set aside reserves. Cash is king. We found that out during COVID. The only people that got in trouble during COVID were the people that didn't have enough reserves. Now, ultimately, the banks kind of came to the rescue of a few folks, but ultimately, most of us got through it because we reserved enough, and we had enough set aside that we were able to kind of weather that storm, even though some people weren't paying their rent, right? Unrealistic or aggressive rental growth, right? Natural revenue growth. This is pre-COVID, now, whatever, typically 2 to 4%, right? Now there could be unique circumstances where maybe years 1 or years 2 might be a little bit higher than that. But if across the board they're showing, let's just throw a crazy number out there, 10%, that in my mind is aggressive. You're not going to see 10% year over year rental growth in any market, doesn't matter what it is, it just doesn't exist, right? So if they're doing that, they're probably being aggressive, right? The exit cap rate or reversion cap rate, the rule of thumb is typically to be conservative, you're going to bump that up on the back end, right? So if I say, for example, I bought it at a 5 cap, I'm going to say that I'm going to sell it at a 6 cap. The rule of thumb is either 15 to 20 bips per year that you hold it, right? Basis points is bips, folks. And then again, no skin in the game. I can't continue to pound that drum hard enough, right? So let me get into a quick case study. I don't know how I'm doing on time here, but I'm going to plow through this pretty quick. So this was a deal that we bought in Decatur, Georgia, which is a suburb of Atlanta. As you can see, these pictures were taken up front. It's a little rough, and it was even rougher. I can't even describe what I saw when I went out on site. There's literally people from the second floor balconies throwing trash out onto the curb, and there was rabid dogs. I probably witnessed a drug deal, and I'm pretty sure that we broke up a prostitution ring when we were there too. So overall, pretty rough, right? This was literally pulled from our deck, right? 10% cash on cash, 100% in 5 years, $900,000 CapEx budget. For people that do single family homes, in a lot of ways, we're not flipping them, but we're putting a fair amount of money into improve these. Anywhere from, and this is just to give you some numbers, $5,000 to $15,000 per door is typically the average right now. And so you can quickly get into a 7-figure rehab job. And so you need to make sure that the sponsors have some idea of how to do rehab jobs and construction management, right? It's important, right? So we focus on the location, the lack of proper management, and ultimately high demand. Decatur's was a growing area. This was in the path of project progress. I would still say that it still is. It just took a little bit longer to get there, right? So you can kind of get, this is just where it's at. Anybody that's familiar with it, south of I-20, the old saying was in Atlanta, you should never invest south of I-20. I've made a fortune south of I-20. I think that there was a lot of, just preconceived, hatred of it. And I think that there was a ton of opportunities, and it was backed up by comps that we saw in the area, right? So these were the projected returns. Once again, I pulled this directly from the deck that we had given to our investors. And as you can kind of see, right, this is what we were projecting to people. So project summary, there was a big upfront eviction that we had to do. There was a lot of people that were not paying rent first and foremost, or had a lot of lease violations, or were just overall scumbags that should not be living in the property as we're trying to improve it, right? So we took, obviously the eviction count. So occupancy on paper went from 78 down to 55. I think it was actually less than that. I think it was more like 45, but regardless, we took it down substantially in order to evict those people. And then ultimately we had security on site. Literally these guys, they're called the SWAT team. They were either off-duty police officers or former police officers, and these people carried guns, and they would call their buddies that were still on the force if people needed to get arrested, and they helped us clean up the property. Now, people are saying, wow, that's a lot going on. You got a $900,000 rehab, you're evicting people, you got security. Yes, this is not for the faint of heart. Let's just put it that way. At the end of the day, people need to understand that this is a deal that probably your first deal should not be doing. Right. But we had a fair amount of experience at this point, and we were confident that we were buying it at such a good price that if we put the money in and we did the hard work, and that's where I lost all my hair, for anybody that was wondering. No, I'm just joking. I lost a long time ago. But anyway, so we had the security help us out. We were able to get the right people in, and then we started pushing rents, right? Collections tripled in 4 months. So, you typically don't see that. That's not typical of a deal, but in this case, because we had evicted so many people, we were able to get them out the door and get paying tenants in, put families in there. We improved the property, and ultimately we flipped out of it. We typically don't call it a flip, but we sold out of it in 18 months and made it almost 80% total return for our investors. So that turned out to roughly about a 50% total return for everybody. So the equity raise, there's the stats, right? We raised 1.1, purchase price was 3.9. We sold it for 7, profits of roughly 2 million after all the closing costs, right? So what does that equate to? That 50% average annualized return, which is far outweighs what you're going to get in the stock market, even probably the last year or two. So this is kind of, I didn't want to give too much here because I only had 30-minute slot, but, I wanted to kind of show the power of what you can do in multifamily and the amount of money that you could potentially make. And like I said, all you need to do is fill out 4 pieces of paperwork, and in the end, just make 1 wire transfer, and that's it. We do all the other hard work, right? And you can do it through your friends there at NuView. So I think that's about it. So yeah, I'm happy to do some Q&A. I know it was a little quick there on some stuff, so maybe some folks had some follow-up questions, or I can kind of clarify a few things.
Yeah, no, I thought that was great, Ben. A lot of good information. I was laughing behind the scenes about how you lost your hair and how you broke up a prostitution ring. I mean, the things that come with real estate, right? Every real estate investor has
never a dull moment, my friend.
Never a dull moment in real estate. So, but it's awesome that you guys do a lot of the work. And, I moved out, from Texas, so I'm familiar with all the areas that you mentioned. And, when you're talking about, south of I-20 in Atlanta, I don't know what it's like nowadays, but it's almost like, third ward area, Houston. I know people didn't want to go into that area for a long time. And before I left years ago, or not years ago, but a year ago, that was kind of a hot spot, so it just really depends. I think where there's, where you have those properties, like you said, as kind of an eyesore, those are opportunities. I mean, that's kind of where Yep, that's where the money's at. We do have some questions, and I think you kind of addressed this one, but I'll just kind of repeat it in case you want to add anything to it, because I know you did talk about the red flags, which was awesome. But Amir, thanks Amir for posting the question, says, how do you screen deals as a sponsor? Any examples why you may have passed on deals? Thanks, Ben, for all your information. So any stories on you passing deals, and maybe what was the story behind that?
Yeah, I mean, we pass on plenty of deals. I mean, I think we're really right now. I mean, we have an engine behind us with a whole underwriting team. I mean, we're probably looking at 150 deals just to find one that we can get under contract. So, in a lot of ways, they're just overpriced, And I think that the quick way to determine that is, purchase price versus rents that you can get in that area. I think even when the broker will try to justify in a lot of ways, oh, you can pop rents $300 to $500 here. Well, you start looking at the median income in that area, and people will essentially not be able to afford rent. So you just need to be very, very careful not to you need to take everything from the broker with a grain of salt, right? And we're friends with them. They know that it's all for informational purposes. Everybody should do their own due diligence, buyer beware, right? So I'm not being mean to them because they know what's happening here. But they are taking a perfect real world thing that may or may not ever happen, and that's what they're putting out to a potential buyer. And so you got to wade your way through that, do your own underwriting, do your own due diligence, and sometimes you can quickly determine nobody's going to be able to afford those rents, or there's not enough growth in that area, or the capex that you have to put into it in relation to the rent growth that you can get is just not there. There's just not a good return on investment. Right. But I would say the one quick way that I just weed through it is I can almost, over a course of maybe 2 minutes, determine if the property is overpriced or not. And you're going to see that in single family too, right? There's just the market is hot, and people are banking on the market continuing to be hot. And really, I don't look at it from a speculative, I'm only hoping for appreciation standpoint. I'm a cash flow guy. And so I need some level of cash flow in all these deals. And if it's just not going to be able to do the level of return that I need, then I'm going to pass on it, regardless if it's in a sexy market or not. Right.
Yeah, it's a numbers game, right? I know one of the pitfalls for a lot of beginning real estate investors is they get emotionally attached to deals. Yep. And you got to take emotion out of it, especially with multifamily. It's a numbers game. If it doesn't meet your numbers, if it doesn't meet your sweet spot, then you just pass on it. No harm, no foul. Yep. We got a couple other questions that are kind of correlated, but Lauren McSorley, hey Lauren, good to see you on the program. It says, how many deals have you done, and what do you consider a loser deal? I think you kind of touched on that, but anything, and I think you mentioned how many deals you guys are doing. Can you speak a little bit about that, and maybe expand on the areas that you're into? I know you mentioned that you're trying to get into Florida, but what areas are you guys currently in?
So we've done 15 projects. I think all in all, we're almost over 3,000 units that we've bought. Right now, we've sold some of that. Right, I think assets under management is probably closer to 2,000. So that's the project part of the question. And I think at the end of the day, right, some markets that we liked, we touched on the Sun Belt. Right, for anybody that's familiar, it's along the South. Right, from Arizona over to Georgia, down to Florida, up to North and South Carolina. We love those markets. Ultimately, those are very, very big. It's a very big swath of the country, though. And as much as I'd love to say that we've got an army of people behind us, we're still a boutique shop. And so we try to say, okay, let's specialize on some certain markets. So here in Texas, we love San Antonio, / let's call it Austin, right? Central Texas. We love Houston. In Atlanta, we love DFW too, but it's just as competitive as DFW, or excuse me, at Austin. We love Atlanta in Georgia, and then we love Tampa, we love Orlando, and we love Jacksonville within Florida. And so right now, and going into 2022, I don't think that it's going to change very much. We're focusing on that because a lot of this stuff is it's built off of relationships that you build in the market, right? We're not doing this direct mail stuff and I'm not trying to hate on that, right? That there's another market for that. I did that when I was in single family too. But when you're buying a $70 million asset, sending a letter to the owner is not going to work, right? So a lot of that is done through broker relationships. And in fact, I'd say probably 99% of it's done at that level through brokers. And so we spend a lot of our time developing those relationships with them, and developing that rapport takes time. So that's why we're only focused on those specific markets, and just to kind of stay in our lane and and then from there, right, as we continue to grow, then you can expand off.
Yeah, Texas is hot. Florida is hot as well. I've lived in both places, and I can tell you very, very similar when it comes to, some of the demographics and just the, the price points, median house price. And I know Tampa is on fire. Jacksonville is on fire. Even Orlando, it's very, very competitive, very low inventory. So, if you have those broker, relationships, and you have the ability to find some of these deals, I mean, it's just powerful stuff, especially in this type of industry. Another question. This is from Richard. He says, thanks, Ben. Great presentation. So is there any software or spreadsheet templates that you use or might recommend to track one's passive investments from different sponsors? That's an interesting
passive
question.
investments.
Yeah.
That's a good point. So I actually, small aside, and this couple's here in Houston, they have 91 passive investment deals, so in itself, that turns into its own job, right? But I mean, ultimately building out a spreadsheet on the passive investor side, I haven't seen one. I thought he was going with that question on the active side. Now I could probably, offline provide a referral on that. But on the passive side, it's probably just building out an Excel and, kind of just maybe probably putting a table, right? What was projected versus what's actually happening, right? It could be as simple as that. And then you just have a tab per deal might be a good way to track that, right? This is the distributions that they said that was going to happen. This is where we're at. Is there any delta there? And then ultimately, if there is a delta, maybe to the bad, is there a reason why, right? Maybe it was COVID, right? Or it could be something else. And do you feel warm and fuzzy that they're working their way through that delta between the two?
Got another question from Lisa Bowers. Lisa, thanks for joining us. Do you ever do deals involving debt equity partners where they are mostly lending partners? And what are the biggest risks to those passive investors?
We do pref equity. We provide pref equity, and that's kind of, for people that are familiar with mezzanine debt, it's kind of like that. But the pref equity is you get the benefit of the depreciation, right? Because you really truly are in an equity position. It just depends, right? Each deal is different. Some deals, I would say, some folks might be taking on too much preferred equity or too much mezzanine debt, and so they're over leveraged. And but we see a lot of benefit right now of doing it, right? Now you're giving up your upside if you're a passive investor in this, and so you're giving up the upside, but you have a lot less risk and you get a more steady return. Whereas the common equity is going to get that upside too, right? And I don't know if that really answers her question, but we love it. We incorporate it in our own deals, and we do provide it to other people in their deals as well. And it seems to be, all the rage these days. Let's just put it that way.
Yeah. Can you do us a favor? We've got some other questions. They're a little more specific to, your specific deals. And if you're looking for certain things, can you do me a favor? Just type your information, Ben, email in the chat. If anybody's got direct questions for Ben, you could just shoot him an email. And if you can voice it too, because this is being streamed on Facebook, they won't see it, but if you could just shoot out your contact information.
I love, obviously, as everybody can probably tell, I love talking shop. This stuff is always exciting to me. So you can check us out, check out our website, www.disruptequity.com, or you can check me out directly at ben@disruptequity.com.
Awesome. Thank you, Ben. And if you want to stick with me, I've just got a couple announcements, and I want to do a little giveaway for those of you who took the time to participate with us. If you haven't heard, you're going to hear now. NuView Trust Company is planning our biggest event in the history of the company, and it's going to be our brand new first annual investor retreat. This is going to be a 2-day event this coming January 6th and 7th. So this is going to be a great opportunity for you to kick off 2022 and come network with like-minded investors, not only from the state of Florida, but from all over the country. We also have a list of speakers and sponsors that are going to blow your mind. And I haven't talked to Ben yet about it, but I'd love to see if Ben and them are interested in coming down to Florida in January as well. To
Orlando, come on, man.
Orlando in January. You can't beat it. Yeah, you can't beat it. So this is going to be, we're hosting this at the DoubleTree Hotel. This is at the entrance of Universal Orlando. It's going to be a Thursday and Friday event. which is perfect if you want to use it as a double up as a family vacation. Come out January, Thursday, Friday, join us at the event. We're going to have some networking functions as well in the evenings, and then you can stay over the weekend and enjoy Universal or Disney World or whatever you want to do. But this is going to be a phenomenal event. We already have over 100 people registered. We expect close to 400 people by the end of the day, or not by the end of the day, by the time we do the event. And I am going to give some free tickets away. So if you are interested in participating as an attendee, we have a website or a website landing page. If you want to just scan this QR code, you can do that. Or you can just go to NuViewTrust.com/investor retreat. There you'll see tickets available. We are having our tickets right now for early bird pricing. We have general admission tickets, which will normally be $199. Right now they're on sale for $99, but I do have some free ones that I'm going to give away right this second. But I just want to explain to you what it gets you. It gets you access to the event all 2 days. We also have a room block available where we've got some pretty cheap rooms. I think they're $130 if you want to book rooms at the hotel that the event is at. Probably real convenient for you to do that. We also have VIP tickets available also at early bird pricing. The VIP tickets, what they get you additional reserved front row seating to the event. Again, this is a 2-day event with about 20 different speakers. So it's going to be good for you to sit right up close and personal with them. We also have a VIP lounge that all VIPs will have access to. We'll have food constantly in there, but you also get lunch both days. You also get a full recording of the entire event. So the early bird pricing alone basically just breaks even on all that stuff. So you're basically paying what we pay to get all that stuff. So if you want VIP tickets, go to that website. And if you want general admission tickets for free, I've got 1, 2, 3, 4, 5, 6, 7, 8, 10. I've got 10 that I can give away for free right now. Do me a favor. If you want the free general admission tickets, I've only got 10. Email IRA specialists, that's with an S, IRA specialists at NuViewTrust.com. Just say, I want my free ticket. You can get a +1 as well. So you can get 2 free tickets if you want to bring a loved one or a spouse, maybe a son or a daughter, if they want to start learning about these investment opportunities through self-directed IRAs. I will tell you our keynote speaker to kick things off, if you know who the man is, Dave Steck. He's made hundreds of millions of dollars, a lot of it through self-directed IRAs. He teaches his family how to use self-directed IRAs. He's going to kick off the event, but this is going to be a big blowout event for us, and we hope everybody attends. And again, I got 10 free tickets. Just email IRA specialists at NuViewTrust.com and say, I want my free ticket, or I want my free ticket +1. One of my salespeople or one of my IRA specialists will reach out to you, give you a special promo code so you can snag those tickets right now. So if you are interested in more continuing education from NuView, just scan that QR code. That'll take you to our YouTube page. We post all of our videos on YouTube. This will also be recorded and live on Facebook. So if you want to rewatch what we just went over and what Ben discussed, it's always going to live forever on our Facebook page. So just go there afterwards and you can rewatch that. And there's that email down there if you guys need it, IRA specialist at NuViewTrust.com. Ben, thank you so much for participating with us. It was a phenomenal presentation. I hope you guys take the time to reach out to Ben if you have any questions. And Ben, if you want to shoot me an email, maybe we can discuss having you guys come down to Orlando in January. We'd love to have you live and in person.
Let's do it, buddy. Let's do it. Appreciate the invite, and hopefully I add some value to everybody.
Awesome. Thank you guys. And thank you for attending. And don't forget, snag your free tickets while there's 10 available. And I'll see you guys next Wednesday for the next Wednesday workshop from NuView Trust Company. Thanks, everybody. And thanks, Ben.